Hello and welcome to this video. In this video, we'll be going through the new version of the financial forecasting model and the dashboards. So this is the new business model. This is the existing business model, and these are the dashboards for each of the scenario. That is, existing business dashboard is this, and the new business dashboard is this. Now there is already a video available on my YouTube channel explaining the every nitty-gritty and entire model. But this particular video is more of an upgrade or letting you know what are the upgrades I have made recently. Now, this particular financial model you can build yourself by enrolling into my course. The link is in the description. So you can go to the link and subscribe to my course on various platforms as per your choice. And you can know how to build this kind of amazing and fully dynamic financial forecast model. But in this video, I'll be explaining you the completed version of the financial model. So if you want to buy this financial model, you don't want to go through a building process or you don't want to enroll into my course, you can always download this particular financial model for your ready use and apply the same in your kind of business or your nature of business. As I explained before, this financial model can be customized for any kind of business. So basically this financial model is for a short term 1 year forecast, and if you have any kind of business other than what I have shown here, you can use the same. For example, if you have a restaurant business, if you have a retail business, if you have a consulting firm, you can use this financial model as a template and just make the changes as required and get on with your forecast for the 1 year. So let's start with the overview of this completed model, the upgraded version. So as you can see, we are in the new business tab here. Here, the financial model starts with the name of your company and the financial year. And here there are KPI cards and there is error check. To start with, we need to put the date, the starting date. So assuming this is the new business, we have planned everything by December 2019 and we are trying to forecast what would be our new business performance for the next 1 year. That is from Jan 2020 to December 2020. So here the business is of more of electronic store or fast moving goods. So we have mobile phone, smart TV, home theater system, gadgets and accessories as our products. And as you can see, the entire model starts with the revenue forecast because revenue is everything in any business. So we start with that. So as you can see, the blue fonts used in the entire financial model is for key input. So here it's a free key in field or a cell, I should say. So you can put in your figures here. And then everywhere, wherever there is a blue font, you can put the data freely. Apart from that, the red fonts are for the indicators, especially error checks and changing the various parameters. And the black fonts, the usual default font color, is for the formula. So you shouldn't touch this unless you know what you're doing. Now for the revenue, we have two kind of scenarios here to focus. So I have here 5 products. And here in this column, which is December 2019, that is column L, we have some predicted revenue or a base revenue for our business. Since we are starting this business, we need to know what would be our basic revenue or base revenue based on which we'll be building our forecast. So here for mobile phones, we are assuming we're going to sell up to $15,000 worth of mobile phones a month. Same way with smart TV, we're going to 10,500 worth of smart TVs. Home theater system, we are assumed that our base sale would be around 8,500, gadgets 11,500, and accessories would be $16,500. So we are assuming the total revenue or base revenue, which would be the optimal revenue based on our own feasibility study and market analysis. This amount of revenue we can do with this business as a startup. Based on that, we're going to be manipulating these figures as a base and using various approach of linear or selective to build our forecast for next 1 year. Now, what do you mean by linear and selective? So linear here, as you can see, so linear here, once you select linear for mobile phones, this particular percentage, 7%, you can change, which is a drop down here. So for example, I have kept it 7%. So 15,000 was our base sale, which is our own assumption and based on our own market analysis that we can sell up to $15,000 worth of mobile phones in a month. So based on that particular base sale, you can increase the sale month by 7%. So the linear means every month 7% sale is increasing. So as you can see, every month 7% growth is added. Everywhere is the same, so you can change the percentage. So if you feel that it's not 7% or want to make it even lesser, 1%, it will increase by 1%. If you make it 0, so let's make it 0 here, it will not change. So whatever the sale of 15,000 will remain same. So this is what it means by linear growth or linear forecast model. It increases the sale month by month by same percentage here. So whatever percentage you put in, it will increase month by month. Now here there is no meaning of putting a negative linear growth, but if there is a scenario where you want to forecast that in particular month of a particular product, you will have a decrease in sales, you can do that as well. So if I put minus 5%, so every month the sale is reduced by minus 5%. So it started with 15,000 in December 19 is our base sale. So please note that this is not December 2019 sale. So this is a new business. So we are assuming this as our base sale. So this is not December's performance or December's sale. So keep in mind that from that 15,000 by 5% reduction, linear growth or negative linear growth would mean that each month 5% of the previous month sale is reducing. So we started at 15,000 and we ended at December 20, 8105, which is 5% reduction each month from the previous month's sale. So it works exactly same manner, but in a reverse manner. That is, it reduces the sale. If there was a positive number here, 5%, it would increase it. So it works in the both way. This can be a scenario where when you feel that your particular product sale will be reducing each month. So you can model that as well. Now that is the linear sales, and now there is one more option you have is called selective. Now selective is more of a practical approach of forecasting your next 1 year's performance of a business, especially revenue. So here in this free key in cell, which are blue color, as I said, you can key input whatever you want. So for example, if I want to increase my sale not by 5%, let's say I want to increase by 15%, from 15,000 to 17,250. So your sale has increased by 15%, and next month you feel that there would be downfall, so you can put it like minus 10%. So whatever your sale was in January, that has reduced by 10%. So your sale has now come to 15,525 in month of February, and so on. So this is more of a practical approach where in some businesses there is a seasonality where sale might boost, and in some business sale might go down in particular month or particular quarter. So accordingly you can input here the percentages of increase or reduction any way you want. So it is more of a freedom given here to increase or decrease your sales according to the scenario. So this is how the sales forecasting is working, and it is based on this particular base sales. Here is the year to date column. So whatever your performance was for the sale for each product, you can see the year's performance. Now below that we have a cost of sales. Now this is inventory business. So for that we'll have opening stock and closing stock. So the basic formula of cost of goods consumed or cost of goods sold would be opening stock purchases minus closing stock. Now here we cannot model or we cannot go on manipulating each factor and make this model a reasonable or even a meaningful analysis. So that's the reason I have kept only one particular KPI, that is cost of goods sold, as a manipulating factor. So here exactly same manner as here, we have two approaches, selective and linear. So here we have some base GP for our particular sales. So this was our base sales which we have assumed and done some analysis before we started our business. And we also assume what would be our base GP on each of these products. So for example, mobile phones will have a minimum gross profit on each sale 30%. Smart TV will have a gross profit of 25%. And home theater system will have a gross profit of 22%, and so on for the two products. So this is our base GP, and in that you can manipulate your GP. Now let's try to manipulate the gross profit, and I'll show you how it works. So first of all, let's select the linear. So here also we have linear and select. So linear again means that each month, whatever percentage you put, it will increase your gross profit by that percentage. So for example, here our base GP is 30%, and we are assuming that each month our GP will increase by 10% month on month based on the previous month sale. So here suppose we put 10%, here the GP for the January would be 33%. Okay, so how 33? So 30% plus 10% of 30% would be 3%. So 30 plus 3, so 33%. So this particular cost of sales is 67% of the sale value. So 70,250 into 67% would be 11,558. So to simplify and explain you this, how this is working, I'll show you an example how the overall gross profit manipulation or cost of sales manipulation is working in the model. So all these things are explained if you enroll into my course. So if you enroll into my course, you will know each nitty-gritty on how to build this particular model. But if you choose to go for just download of this product, that's also fine. That's the reason I'm making this video, to give you a brief tutorial on how to use this model effectively and correctly. Here, let's put a percentage of 10% here, right? We have chosen that, and let's see if I add 10%, this GP now should change to 33. So how it is working? So you have to add 30 plus again 30 into 10 percentage, and we got 33% like this. So you can see it how it is working. If you minus that 33%, so now what is 33%? That is the gross profit of your sale. So per sale you are making 33%. So if I go up here and select the sale of 17,250 for mobile phones into 33%, so I got profit of 5693, and if I deduct that gross profit from the sale, it is 17,250, that is mobile phone sale in January 20, minus the gross profit, I get 11,558, which is same here. So this is how this particular analysis is working, the forecasting model is working. So whenever you change the percentage here, it adds to the gross profit, and you see here not the gross profit, you see the cost of sales. So cost of sales is manipulating according to your change here in the percentage. So here, as I mentioned, there are two methods, linear and selective. So every month you can increase your gross profit by this percentage or decrease your gross profit. So it could be anything. So if I reduce it by 5%, your gross profit will go down and cost of sales will increase, right? Because cost of sales and gross profit has inverse relationship. So accordingly, this model is giving you the figures. Now here, if you put selective and go up here, and this section, this particular section, you can change the percentages. So let's change the percentage for mobile phone. So selective, let's assume we'll have a tremendous amount of profit because of one-off sale. We had a deal with one of the new customers where we got additional 25% gross profit. So here you can see the cost of sales has gone down by a big amount, and we got additional 25% gross profit. So actual gross profit for this month would be this plus into this percentage, enter. So we got gross profit of 37.5% for January in mobile phones, and accordingly this cost of sales is worked out. So we can check that as well. So I'm going to select the sale minus the gross profit, which is this amount, or we can just get a figure here, this into the sale. So we got gross profit of, let me change the formatting, 6468.8. So what will be the cost of sales? It should be exactly same amount here, 10,781. So I will go to the sale minus this gross profit. I got exact same amount. Let me change the formatting, 10,781. Okay. So this is how this particular model is working in case of selective growth of gross profit. So again, in any month, if you feel that your gross profit or cost of sales will go up for whatever reason, you can model it out here using selective approach and changing the percentage here. So in some cases, the gross profit is going down by a big amount, like here in this case of smart TVs. In these 3 months, we have a reduction in gross profit. So June, July, August, for whatever reason, maybe it's because of some uncertain event has happened in the market or economy. So accordingly, you can model it out. So this is a very flexible approach to forecast your business performance in very detailed manner, but at the same time, not going into too much detail. So it is a detailed approach, but at the same time, not that detailed. Well, things will get really complicated. Now here the opening stock, purchases and closing stock are also playing a role here. So ideally, if you had this business running and you had actual data, you'll be inputting these figures from your records, from your finance records. So you'll be putting opening stock of the month, the start of the month, and then you'll be adding the purchases and putting the closing stock. So all these three data will be available with you if your business have a proper finance and accounting system. But since this is a third of forecasting model, we are just manipulating other three figures based on this particular KPI, that is cost of goods sold. So here exactly what is happening here, opening stock would be this inventory. Now here, this particular amount of inventory we have bought from our initial capital. So when we started business, we brought in some initial capital, which I'll discuss later. Down we have a initial capital schedule as well. So here we bought this worth of inventory, that is $21,000 worth of inventory. We bought because we want to start this business, right? We cannot start business, especially this kind of business with no inventory. We need to bring in some inventory. So we have bought this. That's why these figures are manual input here in blue font. So you can input the figures accordingly. So that would be our opening stock in January. at the start of the month or start of the year, I should say. Then the purchases are calculated reversely and also the closing stock. So here I have assumed the closing stock is nothing but some percentage of the cost of sales. So since this is as I mentioned, this is not a actual data here, this is more of a forecasting or a model. I've assumed some percentage, which you can change as well. You can change according to your business environment or a business product or overall how your business is going to perform or what would be your inventory. So here I have assumed that some percentage of this cost of sales would be our inventory all the time. Now, since the formula of cost of goods sold is opening stock purchases minus closing stock, and that should equal to cost of sales, that I'm putting in a reverse way. So here I'm adding opening stock. So first I'm taking M50. What is M50? That is cost of sales. I'm minusing the opening stock and adding the closing stock. So this is more of a balancing figure, I should say. If you know basics of finance and accounting, we have something called balancing figures when you do a formula for arriving some balances. So here this is nothing but a balancing figure. But as I mentioned, if this was a real business, you would have these figures available from your finance and accounting records. So that's how we are arriving the cost of goods sold, and there is error check here, which I am doing reversely. So I'm adding the usual formula of opening stock purchases minus closing stock. That should be equal to this amount, and it is matching. If there is an error, you need to go and look where this error is coming up and you need to correct that. Now below that we have a custom duty, which is other direct costs. So these costs, since these products we are assuming we're going to import from another country, will have some custom duty, international freight and local freight. Now here, according to your business environment, you can input as many other costs as possible, direct costs as possible. So if you have other costs like other transportation or whatever, depending upon the model of your business, you can put in here or you can add more lines here. So here I've assumed that for this particular scenario, we have 3 direct costs directly related to our purchase is mainly here. So it is custom duty, international freight and local freight. So those are also our percentage assumption, which is 5% for custom duty, international freight 5%, and local freight 3.5%. So whenever these figures are changing, this will also change. This is how exactly it happens in real scenario as well, unless you have some special agreement with your freight forwarder that you're going to be having a fixed cost for a certain level of inventory. But that also you can model here. But basically here you need to assume that it will go in line with the cost of sales. Basically purchases, you should say. So I'm here also, I'm putting the purchase figure. So total purchase figure of 5 products into 5% and accordingly for the to cost. So that would amount to total cost. That is your cost of goods sold and also the direct cost. That would give you a gross profit for all 5 products and overall gross profit percentage, which is gross profit divided by total sales. Now here you could go on and make individual performance as well. In that case, you will need to allocate this cost to the 5 products in a reasonable manner or in a reasonable ratio. This could be the same ratio as this one. So you can expand this cost of sales. So in this case, there would be 15 more lines you should need to add. So below this, there would be 5 lines for this 5 products. Below international freight, there would be 5 lines for these 5 products. And below local freight, there would be 5 lines for these products. And introduce subtotal. And then you can have an exact gross profit for each product. So it's fairly simple to do that. And it's not something which it's difficult. And you can easily do that and arrive at the same amount of gross profit. Now below gross profit, we have indirect operating expenditure. So these are indirect expenditure. Like here, we have a lease rental for property, lease rental for vehicles, salaries and wages, utilities. So these costs are for your indirect form of expenditure. For example, if this was our new business and we started this business, basically we need to open a shop somewhere in the mall or any other location. We need to hire a shop floor or a space to keep our display of our products. So for that, we're going to be paying the lease rental. So here you can see. And at the same time, if we have a delivery business or we're going to be delivering the stuff to homes, we need to have some vehicles. So we have hired some vehicle on lease. And there is a salaries and wages for employees which are working on the floor. So they will be paid each month. And this would be more of indirect employees like back office employee who will be billing and who will be maintaining books of account or any other employees. And there would be utilities. So we'll be paying electricity bill for our shop floor, of course. So these expenditure are classified as operating expenditure, indirect operating expenditure, I should say. Now, these expenditure are usually fixed in the general scenario of any business, any small or medium-sized business. But here I have add one more dynamic parameter here where property lease rental, for example, if a certain amount of sale goes up, we'll have an increase or boost in the sale. Now, how is that is working? So for example, our sale has increased from this particular level of, we started at 62 and now somewhere, suppose in May, our sale is now at 82,000. So our business was success and we got a real boost in sale down the line in just 4 months. So for that, we'll be having more inventory and we'll be requiring more space ideally. So in that case, you need to go back to the landlord and agree on a increasing the shop floor you require for your business. So for that, he will definitely increase the rentals. So here, if you go to this ranges tab, and here I have created a template or a table where I have put that amount of property rentals that will increase if this amount of sale is increasing or decreasing. So here basically there would be no decrease, of course. If the sale is below $65,000, our property rental would stay at $2,000 a month. If the sale is between 65, so more than 65 but less than or equal to 80,000, it will be 2,200. If the sale has increased from 80,000, so more than 80,000 but less than 100,000, we'll have a 2530 as a property rental. If the sale increase more than 100,000 but less than 200,000, we'll have a property rent increase, or the total rent would be 2910. And any sale of the sale per month increases to 200,000 or more, or actually more than 200,000 here, the property rental would be 3346. So this is based on monthly sale. Now this can be manipulated the way you want. If you think that you're going to do up to $200,000 a month sale for your business with the same amount of property rental, ignore this complete scenario. You can go to your model here and just put a hard key input of 2000 directly. But if you want to keep this kind of dynamism or dynamic analysis, you can do this kind of formula. So here the formula is actually an if statement, which is complex one. So this also I'm teaching in my course. So I highly recommend that you enroll into the course, because if you enroll into the course, you will get this particular template for free. So there is no, of course you'll be paying a little bit more because you'll be learning a lot and there is more time to be given. It is the best that you enroll into the course and learn to build this kind of model step by step. Not only that, you'll learn more tricks. You'll learn the basics of Excel and formulas function as well. You'll also learn to build this kind of amazing dashboards, dynamic dashboard as well. So a lot of more things you can learn if you enroll into the course. But in case you have no time to go through the course, which is more than 10 hours actually, you can just use this model and you can just change this particular scenario. So it's up to you how you want to model it. So here I have kept this kind of scenario. So same with vehicle rentals, overhead, salary and utility. So this all based on the sale. Now, as I mentioned, if your business is some other nature, you can model it accordingly. So this cost may be fixed for you. It may not go up. So you can just keep 2000 everywhere. You can keep 750 everywhere. You can make a break here. It's up to you. It's fully dynamic. You can customize it the way you want. So that's how this particular cost is coming up, indirect operating expenditure. Below that, we have a finance cost and LOC. So this is the most crucial part of this entire financial model. It is complicated at once, but when I explain you, and of course, again, if you go through my course, this will be explained in very detailed manner. But here I try to explain you in as simple manner as possible. So here we have three kind of finance costs. One is long-term bank loan. One is LOC, which is a bank overdraft, which is a temporary finance. I'll explain you that in a moment. And then we have depreciation of cost. So this depreciation is based on our fixed asset, because of course, this is a new business. So if you're going to buy a shop floor, we will need some shelves to keep our products. So any other table, chairs and other basic stuff, or even other assets like computers, billing systems, softwares, we will need those kind of fixed assets, and for that there is a depreciation here. So that's a straight line depreciation. For the sake of simplicity, I have assumed here. And here, if we are selling any fixed assets in a year, there is a profit or loss on the same. So I'll explain that to you when we go to these schedules. There are individual schedules for all these 4 items, so don't worry, I'll explain that to you in a moment. Now below that, we have a total overhead and finance cost, and then we have a net profit. So net profit is nothing but gross profit minus this cost. So we get the net profit percentage of 17% in January, and so on for each month and total as well. So that concludes the entire income statement, or I should call it a profit and loss statement. So now right below that, we have a amazing and fully dynamic and very useful and actually a lifeblood of any business. That is a cash flow statement. So cash is the king, as we all know, and managing the cash is very important. So here this model assumes the accrual method of accounting. Now again, I'm referring to my course where I'm teaching everything about accounting as well. So basics of accounting, accrual and cash accounting, all these concepts are taught in my course. So I highly recommend that you check out the free preview videos of my course and go through them and then make a decision. Again, it depends on your own scenario. If you don't have time, like 10 plus hours to spend, but then again, it's not a wastage of time. I would rather call it a very valuable investment for the future. So in that, I explain all accounting concepts as well, basics of accounting for non-finance people as well. So again, go through the course and you'll understand more about this model and also finance and accounting basics. So here we have assumed this is accrual based of accounting because most of the businesses these days have adopted the accrual accounting concepts rather than cash accounting. The cash flow statement starts with the cash sales. So now in this particular model of business or this particular nature of business, we will have some on the counter cash sales. So here you can assume the amount of cash sales you are having. So for each products, you can free key in whatever the cash sales you want to key in, or if you choose to go with linear or fixed, I should say, not linear. So for example, if you choose fixed here, the mobile phones, accessory and all these sales, 10% of the total sale would be cash sale. So whatever the total sale is, for example, in the month of January, we had a sale of 70,250 for mobile phones. So if I go down, so I selected fixed and 10%. So 10% of month sale would be our cash sales. Okay, and same with others. So, but if I choose selective, like in actual business scenario, the percentage of cash sales and credit sales would be vary in each one. So this is more of a realistic approach. So here you can input the amount of cash percentage of sale in each month and based your model accordingly. So here you can change the percentage accordingly for the cash sales. That is a linear or fixed percentage, I should say, not linear, fixed. So fixed percentage would be applicable from here, from this drop down. So if you change anything here, the figures would change. Now below that we have a credit sale. So whatever is not the cash sale would be credit sale. So here let's take this example of mobile phone. So for example 1725, which is 10% of our total monthly sale, is the cash sale. So what is the remaining? That would be credit sales. So credit sales is modeled here accordingly. So total sales minus cash sales is the credit sales. Now credit sales means you're giving credit to your customer. Now giving credit to customer is a very good business strategy, and in any kind of business, if you keep your payment terms on cash basis, you'll have a very minimum amount of growth in the business. So giving credit to a loyal customer or a credit worthy customer is key to give your business a really boost in terms of sales and also building relationship with loyal customers. So here for 5 products, we have a different credit days. So 30 days here for mobile phones means that whatever sale you do in a particular month will be collected in 30 days in the next month, right? So we have total around 6 categories. You can see here 0 days also. The 0 days would mean that whatever sale you do on the first or any mid of the month will be collected by end of the month. So this is more for less than 30 days credit if you choose this. So basically it's a cash sales if you say, but then again in the real world, when customer promises you they're going to pay you in like less than 30 days, it will be modeled here accordingly. So it might seem like it a cash sales, but it's not a cash sales actually, because customer is paying within that particular period of 30 days. Now if I make 30 days here, whatever sale we did in January, credit sale will be collected in February here. So you can see it's coming here. And this month's sale for February is coming in March, and accordingly. So March sale is collected in April, and accordingly each month, next month the sale is collected because the credit days is 30 days. So whatever sale we did in January, the credit period will be 30 days and all the customers will be paying you back by end of February. So that is the idea behind 30 days. So if you change to 60 days, whatever sale you do in January will be collected in February and so on, right? So 60 days credit is good for if you have a very large order from a customer, but then again, you need to keep in check how much your cash flow will be impacted. That we will see when we see the overview at the end of the video. So here you can select the credit days. So for example, if you choose really long credit days, your overall cash collection will be really bad and you will struggle with the cash. And you see what impacts would be when we see the overview of the model at the end of the video. So here you can model your credit days accordingly. And the amount of collection is based on this particular selection. So that would amount to our total collection or total cash inflow of the business. So it's basically nothing but amount of cash sales you did in a month plus the collection. So in the month of January, since we have given this credit days to customers, we have a zero collection in the month of January for the credit sales. So all the collection are starting from February. So let's make this 30 for the sake of simplicity, like this. So for January, we have only cash sales as our total cash inflow, but from February, we have collection coming in from the credit we have given. So that will be cash sales plus the collection. So 51, 213 and so on. So below that we have purchases, exactly same concept, but here for the purchases. So here we also have a breakup of fixed and selective percentage of purchases. So in ideal business scenario, there would be cases where we will have to purchase on cash because we have shortage of inventory or there is a urgent demand of a particular product. We will have to go back to our supplier or dealer to buy something on cash basis by paying them cash upfront rather than on credit. So here I have modeled the cash purchases here. So here also, if you keep your cash purchases minimum, it is best for your business. So in that case, you'll be having credit from your supplier. So whatever is not a cash purchase will be your credit purchase. So here the amount is referred is this particular amount purchases. So these are purchases where we have to pay either through cash or we get credit from our dealers or our suppliers, I should say. So here same concept. Here the idea would be in most businesses that you need to get maximum credit period from your suppliers and minimum you should give to your customers. So that's how these things work. So if I go here, suppose I have 30 days credit, or for example, if I have given 30 days credit, ideally I should not get less than 30 days credit for this mobile phone from a supplier. Otherwise I have a negative position for that particular month. So let's see an example here. So for example, here for mobile phones, we have 30 days credit, right? And here we have 30 days credit from a supplier of the mobile phone. So if I make it 60, we'll have a better position than our sales, right? Because we are selling our goods in 30 days and we are collecting in 30 days, but we are paying 1 month after that. That means we are in good position. We are getting 30 days extra. So that will impact overall positive cash flow for your business. This is ideal situation. But if you have, for example, 60 days credit, and here if you have 30 days credit to supplier, you are in negative position because you are selling your goods at 60 days at the same time for the same product. You are paying your supplier in earlier than 60 days, that is 30 days here. So this is not a good position. So always try to maximize your credit period with the supplier and minimize your credit period with your customer. So that would be the ideal cash flow, or you'll have a healthy cash flow to run your business or invest your business further for a future growth. So this is how this entire purchase cycle is working, and here you'll have a total cash outflow. So here same scenario, based on your credit period, you'll have a total cash outflow. So the cash purchases and payment for the credit purchases each month. This is the total. Now below that we have a total indirect overhead payment. So here also we have some credit. So for custom duty, we have credit of 0 days because custom duty ideally is paid at the airport or at the seaport, wherever your goods are coming from. So there the government authorities ideally will not give you any credit. You just have to give them check in order to release your product. So for that I have kept it 0 days. So whatever the expenditure for that month, you have to pay it immediately. But for international freight and local freight, you can have some credit from your supplier. So for example, local freight I got 60 days. And for international freight, I got 30 days. So accordingly, the cash outflow will be modeled here. Same with the overhead and payment. So for property, anywhere around the world, the property is always paid in advance. But here also there could be scenarios where you have a monthly advance, quarterly advance, or semi-annually or annually. So here we have assumed this quarterly advance. So whatever the rental is for the quarter, for example, if you go up and if you select the rentals for first 3 months, so 2200 into 3 would be 6600. That you'll be paying upfront right here in January, and next 2 months would be 0 because you already paid for those 2 months. So you're paying in upfront. So all the lease rentals will always be upfront. So if you make it monthly, you'll have an optimum cash flow situation because you'll be paying or breaking your payments into monthly, which makes your situation more manageable if you're struggling with the cash flow. Let's change back to quarterly. Similarly, for vehicle lease rentals, usually there is an advance, but in some cases you can make a deal with your vehicle lease supplier and get a credit. So here I have put credit, but in case you don't have credit, you can make it 0. In that case, you'll be paying it each month or beginning of the month. That would be same scenario. The cash flow situation would be same. Let's make it 30 here. Now for salaries and wages, you cannot have any credit, of course. You have to pay your employees. So every month you need to settle their dues. Same with the electricity. In case you have electricity credit from if your electricity company, if your utility company is a non-government or it is a private company, it might give you some credit if you make a deal. But ideally, I would assume that every month we need to settle this electricity dues. Bank loan, you have to settle it accordingly. So this is the long-term bank loan interest, which I'll explain in a moment. So every month we need to settle the interest. This would be our total cash outflow, and this would be our cash flow from operations. So what is cash flow from operations? So total collection we did from our normal business minus the total payment we did for our normal business. So that would be cash flow from operation. And below that we have a OCF conversion, which is here. So OCF conversion is nothing but your cash flow from operation divided by your net profit. Right? So if you go here, this is our net profit 11,414, but if you go to OCF, it's negative. So this is not a good position or good situation. But at the same time, we know that this is a new business, so we need to give some time this business to generate monthly positive cash flow. So if you see from next month onward, we have no problem. Of course, there are bumps here and there, up and down, but overall, we are doing very good. Ideally, it should be 100% of your profit should be converted to cash. So that's what this OCF conversion means. Anytime in your business, you need to have 100% of your cash conversion. Your profits, your net profit should be equal to your cash flow from operations. So that will give you a real picture of your business and it will show the efficiency of business. Also, if you're going for a loan or if you're going for a partnership or investment from venture capitalists, for example, they will see these kind of KPIs in your model and they will see that how your business forecast is and how exactly you are performing. So if they see that you're performing more than 100% of your net profit, that means you're very good in managing your credit in terms of cash inflow and outflow. They'll be really happy and it give you more extra points to get an investment you're looking for. This will also be looked by bankers if you're going for a long-term loan or short-term loan. Now below that we have other payments. For example, we have a capex, that is fixed asset. So initially when we started this business, we brought in total capital of 111,000. So $111,000 we brought in from our own funds or from any other sources from our families. Maybe I have put an assumption that we have brought $111,000 as capital. And out of that we have invested 90,000 in the capex and $21,000 in inventory. So this is a very basic assumption. That could be more investment you need to do. You might need to pay for upfront trade license and other stuff. But for the sake of simplicity, I have kept only these two cash outflow initially. So here you can see this is the total of these two. So accordingly, if you change the figure here, your total capital requirement will change. So here we have sale of fixed assets. So when you sell any fixed assets, you'll have a cash inflow that I'll explain you in the schedules below, and also repayment of bank loan. So we also have a bank loan repayment which we have taken over 3 years, so that we need to pay the principal portion here. That I'll explain you in the bank loan schedule. Now here again we have interest cost, that is finance cost and LOC. This will fluctuate each one based on the credit we are getting from our bankers. And this is the line of credit inflow, line of credit outflow that is coming from this schedule below. So whenever we have a deficit, for example, in month of January, we had a deficit, that is negative operating cash flow. We needed some funds and that's why we had an inflow of this amount. And how this amount is coming, I'll explain you in the schedule below. Similarly, whenever we have excess funds, we are trying to pay off our LOC, that is the short-term loan. So we don't incur that much interest. For example, here the interest was 84 because we took this amount of loan. Next month we paid off 5535 because we had some cash and the interest got reduced. And next month we settle completely, so interest goes to zero. So accordingly, this model is working fully dynamically to even forecast your or manage your finance costs from short-term sources like a bank overdraft or trade finance or LOC. So we'll see more about this in the below schedules. Now here, after that, we have net cash flow. So this was the operating cash flow minus the non-core business. That is, these are part of business, but they are not showing any performance of our business. So this is called other cash flow. So that total would be 4916. So that is net cash flow for a business for a month and entire year. This is the opening cash. So we have zero opening cash. So this was the opening cash in the December, but at the month end of December, at start of January, we have spent this amount in the fixed asset and also inventory. So we have zero opening balance, and whatever the net cash flow would be our closing balance. And accordingly, next one, this would be carry forwarded, this would be carry forwarded, and whatever the performance is will be added, and we'll have the closing cash balance. So there is a check below which should be always 0, and if it is not, you will see error here. This is a grand error check which I'll explain you in a moment. So this should always be 0, and individual error check should be 0, or very minimum, just to avoid any big error at end of the modeling process. Now that concludes the cash flow, entire cash flow. So we have done with the net profit, that is income statement and the cash flow statement, and right below that we have very important schedules. So these are supporting schedules. So here the first schedule is equity and loan schedule. So as you can see, we have own money of 50,000 and 61,000 we have brought in as a bank loan, and the interest on the bank loan is 4.5%, and the term of the loan to be repaid is 3 years. Okay, and here we have the schedule. So capital is our own, so we don't have to pay back anybody, it's our own fund. But for loan we need to pay it each month. So there would be principal payment and also interest. So accordingly the schedule is working. Now below that we have very important trade finance schedule, as I talked before. Now here you see there's a difference between the two interest rate, as you can see. So when you get a loan from a banker or financial institution, they will give less interest for a mortgage or a long-term loan, and they will give you very short-term interest, because usually this kind of loans, the long-term loan more than 1 year, given based on some security. So that's why they'll keep the interest rate lower. But for the short-term loan, usually they just see your balance sheet and performance, or even based on the relationship or based on your past performance with the particular bank or financial institution, you'll get this kind of loan without any kind of guarantee or any kind of mortgage. So they just give you this loan based on your, or a good faith you should say, based on their relationship. So that's why they will keep this kind of interest really high. So I have assumed here 7.5%, but you can always increase this percentage accordingly. So you can see here, you can increase up to 12%, right? And here also you can change the percentage according to your own arrangements with the bankers. Now here this amount, minimum cash required would be $5,000. Now this cash is very important to keep our business afloat. Anytime we need $5,000 in our bank account to pay off our minimum wages and other dues each month. So that's why I assume this amount of $5,000. So every month when we do assessment whether we need cash or not from temporary sources, we will need this particular amount all the time. I need to make sure this amount is included here. I'll explain you how it is working in a moment, but this amount you can change according to your business nature or environment. So if the business nature is something else, you need more cash or less cash, you can put this figure here. Now let's understand the trade finance schedule. So here in the trade finance schedule, we have the opening balance. So this is our opening balance of cash. So at the start of the year, we had 0 amount of opening cash because we already invested in the fixed assets and also in the inventory. So now we have assumed cash flow from operation. So what is the cash flow from operation, which is coming from our this OCF, that is cash flow statement. So here we see 6892 is our negative cash, and here we have assumed that we're going to need $5,000 minimum plus the repayment of your installment of the loan, because you cannot miss this installment, otherwise you'll have a bad relationship with your banker. So this loan amount is also our minimum commitment. So 5,000 plus 1586 or whatever the amount it may be, because this is a reducing interest, so the principal will change each month. So accordingly the formula is considering these two amounts. So we got negative 6892 from our business operation, usual operation, but we needed 6586 as our minimum cash requirement for the month. So total requirement for us would be this plus this. So minus, this is doing a minus here in the formula. So here we are needing 13,471. It is the summation of these two amounts, and based on that we are having interest. So here the amount we borrowed in the month of January is 13,477, and that would be the LOC balance, and on that we will be paying interest based on this percentage of 7.5. So in the month of January we had a LOC from bank 13,477, and on that 7.5% per month would be $84 our interest, which is linked here everywhere. You can see in the P&L as well. So more loan or interest you take, your profitability will be affected, right? So you need to ensure that your overall cash flow is healthy. That's the reason I was mentioning that you need to have a proper credit strategy. Credit to your customers should be minimum, while credit from your supplier should be maximum. That will completely change the overall cash flow situation of your business, and we'll see and play around with these figures when I conclude this video. So this amount will change accordingly. So if you have more credit given to your customer and less credit you are being given by your supplier, you will have this interest cost really high because you have a negative cash each month, right? So accordingly, this revolving cash flow situation is happening here, As you can see, this is more of a revolving credit. So whenever we have a need, the cash will coming from the bank, and whenever we have excess cash, we are paying it off. So next month we had opening balance of 4916. We got a business cash flow, that is operating cash flow of 7211. We needed this one. So basically our requirement is not that much this month. We have 5535, we have this. So we have excess cash balance of these two. So these two will be a total balance of 12,127. Out of that, we need this amount all the time. So we minus that. So the balance would be 5535. So 5535, we have excess cash in the business. So we can pay off some of it to our loan. So that is our LOC. So we have paid this 5535 to the banker, that is LOC. So our balance has reduced to 7942. So if I minus 13,477 minus this amount, I got this figure. So this would be the remaining LOC balance for us to pay to our bankers, and on that the interest has reduced, right? So the whatever the balance at the month end would be, on that amount the bank will charge the interest. So from 85, since we have paid off around 5,500, the interest has reduced to $50. And from next one, you see we have more cash flow coming in. We got good healthy cash positions. We have paid off this amount as well. And the end of the month, since we have a zero balance of LOC, the interest is reduced to zero. And from then onwards, we never needed LOC from bank at all, because we are now self-sufficient. We have a sustaining cash flow throughout the year. Now below that, we have a fixed asset schedule. As you can see, this is a detailed version of fixed asset schedule. You can also compress it and make it very macro level schedule as well. But for the detailed analysis and for also reconciling our cash flow with the indirect cash flow and balance sheet as well, I have prepared this particular schedule, as you can see here. So here we have many assumptions. So asset and deletion are used in the same line. Since this particular schedule purpose is to give you forecast of your profit and loss and also cash inflow and outflow from sale of assets. A lot of concepts and a lot of technical things have been ignored here, but most of the simple stuffs have been taken care. So here again, if you follow my course or if you enroll into my course, you'll be able to understand how this exact model is working. But here I'll give you a quick overview of this particular schedule. So here the breakup of the asset, as you can see, we have straight line depreciation percentage here. And here this asset and addition and deletion. So here we are adding and deleting assets. So we have 1500 addition in March, and then we have a sale of asset. This is the gross cost reduction. So if you know the fixed asset accounting, for which I do have a course available, the link is in the description. So to understand this in more thoroughly, or if you have no knowledge of fixed asset and how depreciation accounting works, I have a full-fledged course with a Pro Excel template available. So you can check out the link in the description to know more about it. So here we have addition and deletion of assets. So these are the gross cost of assets. So accordingly, throughout the year, we had a total addition, net addition of 3,100. Now below we have a sale value of assets. So there is a reduction of $250 worth of assets, and that asset was sold for $100. Accordingly, the depreciation per month will be adjusting addition and deletion based on this gross cost. And here will be depreciation on sale of assets. So this is all technical stuff regarding depreciation accounting. So it is, if you're going to use this template as is, you can just drag the formulas up and down and ensure that overall validation is zero. So you'll be fine. You don't have to understand fixed asset accounting in detail. So that is taken care here. So here we have accumulated depreciation, and then we have profit and loss on sale of assets, right? So again, if you want to understand and build this particular fixed asset schedule in detail as part of this financial model, please enroll into my course. The link is in the description. Now next we have a schedule for indirect cash flow. So now in my course I have explained there are two methods of cash flow preparation in finance and accounting. One is direct method and one is indirect method. So indirect method of cash flow is more logical, and also it goes hands in hand with the accrual base of accounting, right? So if you're following accrual base of accounting or accrual accounting method, this particular cash flow makes more sense. Now this is purely accounting thing, and if you have enrolled into the course, don't worry, I explain everything in that particular course. What is this all about? And I explain each and every nitty-gritty of indirect method of cash flow and the balance sheet. So these are automated. If you're going to buy this template and download it and use it, this will be automated. Of course, you'll need to do some changes in this particular schedules because your business would be different. But don't worry, I'll be happy to support when you have any need to modify this particular template. So this is all automated, and basically I'm checking that cash flow from direct method, which is the main cash flow here in this template is matching with indirect. So every KPI like operating cash flow, net cash flow must be matching. At the same time, the balance sheet is also automatic. It must be matching. So balance sheet, if you know the basics of balance sheet statement, it must match. So asset must be equal to liability. So this ensures that overall modeling process is more foolproof and it follows the basics of accounting as well. So that's why we have control checks everywhere. Here we have control check. Here we have control check. Everywhere we have control check, and all this is the sum of all the checks. So this must be zero, a very minimum amount if you don't want to dig in that much. Now here we have KPI cards as you see on the screen. So this shows main KPIs of the business: revenue, gross profit, net profit, and OCF. This is done through a formula with joining the text and also the text function itself, and also formatting. So accordingly, whatever the business situation is, whenever you change anything, for example, if I change to linear, you see everything is changing. Now this is the new business dashboard. As you can see, this is a very professional looking dashboard, and in my course I also teach how to prepare this dashboard step by step, and all these advanced charts I have used, other tools I have used are also taught in my course. So I highly recommend that you enroll into my course. The link is in the description. So if you go down, we have a data which is coming from the model itself. So wherever you do any kind of changes in this model, any of these scenarios, the dashboard will be updated accordingly. So we have 4 charts here. So one is the chart for gross profit, that is sale and gross profit. So each month we are seeing how much is a sale, against that how much is our gross profit. Below that we have gross profit percentage. So here this chart is quite dynamic. It will show highest gross profit and lowest gross profit throughout the month, throughout all the months in a year. Similarly, net profit also is there. It shows the net profit percentage and also highest net profit and lowest net profit in terms of percentage is shown here in this particular chart. So this is a group chart. There are basically 3 charts in them, 3 column charts, and it's grouped together and made this kind of beautiful visualization. On the side, we have a chart of visualization for product-wise details. So here we have a mobile phone, smart TV, home theater system, gadgets, and accessories. This is all linked and automated. You can see the sale percentage and also gross profit highest and lowest, and net profit highest and lowest. So obviously we have this gross profit which is highest for accessories. Let me arrange this like this. So accessories has the highest gross profit and net profit because accessory usually gets you more return on your sales. So accordingly these charts are working, and these are again KPIs. Same method I have used here like this, and made it just more beautifully sync with the overall visual of the dashboard here. Below that we have a OCF chart, as you can see. So this chart shows the monthly performance of our cash flow. So we have a collection, payment, and sales. So these light brown bars are for the sales, against that how much we are collecting. So from the January we had very low collection and also low payout. So sale was high, but since we have credit days, next month this gap is reducing. So from sale and collection gap is reducing each one, which is a good sign, right? And below that we have a OCF performance. So what is the operating cash flow and how it is performing? So in the month of January we had the lowest OCF of -6, and then each month we are showing plus and minus, and with this blue bar which is completely dynamic. So this shows the highest OCF in the year, which was in September. And if this was in December and it was like say around 20, this particular visualization will change accordingly. So this is how this overall dynamic chart is working, and this particular chart is for the product distribution. So this particular donut chart shows how much each product is contributing in terms of our sales, overall sales. So as you can see here, our highest sale pie, or you can say the donut section, is for accessories, and then it is followed by gadgets, and then home theater system, and then smart TV and the mobile phones. You can use other charts as well, it's all up to you, but in this particular scenario I have created this kind of chart. There is a visual in the background. It shows the financial performance dashboard for the new business, and this is the name of your company. This is the existing business financial model, as you can see, and here we have assumed that the business is ongoing for at least 1 year. And here you see the gray columns, gray highlighted columns from M to X. This data is fixed and these are based on your finance and account. Since this is existing business, you'll have this data available from your finance and accounting record. So everything is freezed here. There are no formulas, right? And your forecasting starts from January. So Jan to December, ideally you should input, if you're going to use this particular model and methodology, You need to input the actual data, and your forecasting will start from January 20. And accordingly, based on your past data, for example, here you see from the past data, January 20 forecasting is happening, and also other KPIs. So exact same approach, but here we are just putting last 1 year data to ensure that our forecasting for the future, since this existing business is ideal and perfect. Okay. So same concept, everything is same, but this is the real data we need to feed in for the next 12 months. Also other data as well. For example, you need to put your real balance sheet data, fixed asset data, and accordingly you can do the forecast for existing business as well. This is the ranges tab where we have put different data validation ranges. So sales ratio, interest, everything. And these tables are prepared to work with our dynamic operating overhead. So for this, so if you had a fixed amount of overhead throughout the year for existing and new business, you don't have to prepare this kind of tables. And this is for the credit period. So whatever credit period you want to input, you can input here, and accordingly it will be calculated here. Okay. But here in credit period, you need to keep in mind that I have capped credit period of 30, 60. But even if it is 45 days, end of the day, it will always fall in the next month. So if you had a 45 days credit period, of course, the whatever sale you did will fall in March only. So it is as good as 60 days, because usually you close the books in the end of the month. So whatever measurement or performance you're evaluating is always at the month end. So that would not change this scenario as well. These are the function I have used in creating this entire financial model and dashboard. So once again, if you are enrolled into my course, you will learn the basics of all these formulas and function as well. The link of the course and the preview videos, free preview videos, are available in the description of this video. So that concludes this particular video session, this entire tutorial on how to use this already prepared financial model for your own business. As I mentioned before, this is a very macro level, I should say, but at the same time quite detailed. So it's a mix of both worlds where you can do a very deep analysis as well. You can make this model as complex, and it's all up to you how you want to use this model. So link to download this model in the description. And if you have any questions, if you need any support, you can reach out to me on my email address, which is also available on my website. So go to the landing page of website and learn more about this particular financial model and how to get it. And there is an exclusive discount as well. All the links are in the description. You can go and check out how to get this particular model. So that concludes our video, and thank you so much for watching. And if you have any questions, you can leave them in the comment section below, and I'll be happy to answer them. Thank you so much.